Well, all kinds of requests here. Like Ryan says, pound Aussie. Well, I'm bearish on the pound and I'm neutral on the Aussie, so that wouldn't be a good cross for me to cover. Pound yen. Well, I've already covered a pound pair and I've already covered a yen pair. Put the two analysis together, it wouldn't be much different. When you jam its stop, is it arbitrary or based off of technicals? I would say technicals. You know, when I jam a stop, I'm like, you know what, this should work. It's either, or it's going to fail right now. So I jam my stop and I just move on to another trade. See, think of this, guys. If you made 100 trades a month, it's only 5 trades a day, right? You made 100 trades a month. You enter them all short term. You look at longer term charts. You look at the daily, the 4 hour, okay. But you kind of really only trade the 1 hour and the 15-minute. And then when you pull the trigger, you really only use the 5-minute or the 1 minute to actually pull the trigger. But you include all this other analysis, right? Or at least that's what I do. Great. And let's say you wait for good entries on the 5-minute chart in the direction of your strategy, which again is something I teach. Fine. And I pull the trigger on the 5-minute chart, 20 minutes, 30 minutes later, I'm up 30 pips. Okay? You got the scenario in your mind? And we're about to make another cycle back. I do this one at a time. So in 5 hours, in 4 hours, I can make 5 trades. Depending on the conditions. Sometimes I can make all 5 trades in an hour, whatever. But you get through that first 5-minute cycle where you shorted at resistance and it went down, 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 down. And now you've run out of room. We're going to get some green candles, right? Isn't that the normal thing? There's 3 things that are likely to happen. It's going to have a Fibonacci retracement. And then it's going to fall in the direction of the trend. It's going to make 100% retracement, because that's not a fib retracement, right? It even blows past the 786 and goes all the way back to where I entered the trade for the first time. It does happen. I don't like it. It means it's a volatile, choppy market. Maybe you're a little early, maybe you're a little late. I don't know. But it usually shows mediocrity, right? So anyways, so you get knocked out, but you don't really lose any money, right? And then the third one is the whole thing reverses. You're completely wrong, and it's completely going the other way. Fine. But over the course of 100 trades, you're going to sort of get the law of averages, right? So if you're a long-term bear, you see on the long-term charts it's bearish, you identify 2 or 3 levels of resistance. On a 15-minute chart, you wait for a nice overbought scenario, and price is now touching your sell zone. Then you drop into a 5-minute and catch a 5A cross or a 1, 2, 3 or whatever your trigger is, and 30 minutes later you're up 30 pips. You do this 100 times a month. How many times are you going to be completely, totally wrong? Out of 100. 40. Holy crap, really? All right. Charlie says 33%. 20. All right, well, all right. All right, well, let's say 25. Honestly, when you have all those things, but whatever. All right, so 25% of the time you're completely, totally wrong. You looked at a long-term chart and you said bearish, but for some reason it's bullish. Okay, fine. Okay, so and then what about the times you get knocked out at break even? What do you think? Another 25% of the time? All right, so then let's. Some people, their numbers are higher than mine. So let's go with the higher numbers that some of you guys are saying. Let's say you lose 33% of the time and you break even 33% of the time. So now 33 times a month, you have winners that are bearing at least 30 pips each, because what you're saying is the Fibonacci retracement created a Fibonacci extension 33% of the time. Okay? So you have 33 trades worth a minimum of 33 pips, but honestly are on their way to 66 to 99 pips each, right? Because you got the long-term trend, you sold at resistance when it was overbought, and all that kind of stuff. They're solid trades. I mean, honestly, I don't know how you could be break even or lose 66% of the time on a solid plan like that, but using your numbers, right? You got 33 trades with the potential of 100 pips each in the course of a month. Right? There's your 3,000 pips. Okay? Now you got to count for those losers and stuff, so okay, you only walk away with 2,500 pips. Okay? Do you see the secret, guys? Planning, preparing, entering, reducing risk, letting the winners run. So there's like, I don't know, a little trader psychology for you, right? It's all in the numbers, guys. Even if you're mediocre 33% of the time, another 33% of the time you suck, but 33% of the time you let the winners run, your minimal acceptable performance now is 33 pips, because all of those trade setups set up with 33 pips. See, that's why I think maybe we misunderstood each other. I think you're a better trader than that, or at least you should be, right? But that even then, if you let the winners run, you have a chance. Jam the stop and let it run. Just find another trade. So let's do another pair. We'll just count that one as a trader psychology session, huh?